Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Equities across the Asia-Pacific moving in a, quite a narrow range, as you can see on your screens, as traders prepare for this flood of earnings out of China. The U.S. elections coming up, of course, and economic data that could shape the next Fed rate decision. Also heads the U.S. finalizing restrictions on investment in China's chip and AI industries in a bid to stifle Beijing's tech and military progress. Plus, GE Aerospace says it would be foolish to bet against Chinese plane maker Comac. We hear exclusively from CEO Larry Culp.
Yeah, we're treading water here this morning, as Dave mentioned, right? We're bracing for all these sort of event risks the next few days and weeks. And really, the election outcome certainly is still one of the key focus and risks for investors here. So certainly you're seeing that when it comes to how Bitcoin is doing, for example. We briefly touched that 70,000 level. So some of these Trump trades seem to be getting more and more priced in. The first time since June, we did hit that landmark. Brent, also, we talk about that slump. Yesterday, we've recovered a little bit, but we're just steadying here this morning. Stocks are not really doing too much. It's a mixed picture across Asia here, Taiwan coming online, and we are seeing about 0.75% to the downside, and U.S. futures are pretty flat as well. Treasuries did resume that decline overnight. We stabilized here in the Asia session, but yes, we had a 2- and 5-year bond auction, both of which didn't really yield that much demand. So there are a lot of lingering concerns about supply, the election jitters that really did maybe lead to that outcome in some ways. You take a look at how the dollar is and how people are positioned. I think it was for like hedge funds. These are the asset managers are actually long the dollar for the first time since August. If you take a look at how money flows are going. We're looking at the yen. A little bit of recovery there, 152, 153 levels still, as we did hear from Ishaba, the prime minister, pledging to restore some stability after that shock LDP election. Nevertheless, though, not much going on. Take a look at how the Gold Dragon Index, though, did overnight and actually did pretty well. We saw some upside, about 4%. But we take a look at what happens here in Asia and in China in particular. It's been pretty slow going. We're going to talk a little bit more about BNP Paribas. They have fair value at dollar China, Dave, at 7.7. We're going to ask Ju Wang how she got to that number. You take a look at how the tariff risks are concerned, the election risks and all that. That's maybe why we're here today. You take a look at where we are, the approach to the open. Futures are looking like this here right now. We're watching very closely what goes on with the earnings season, as Dave mentioned, in China. Also one of the busiest weeks of U.S. earnings as well. They're talking about 42% of the S&P's market cap, including some of these big tech names like Apple. They're going to be reporting the next few days. Futures, though, are pointing positively this morning, Dave.
Yeah, and I think what Yvonne did not say is really also underscores the market story today, right? So we talked about everything, elections, tariffs, earnings. We haven't gotten to the Fed. I mean, does the Fed take a backseat, I guess, is the other question, too. To Yvonne's point, right, when you look at our MLive Pulse survey that just came out, these Trump trades, and, well, based on the survey at least, the expectation is the U.S. equity market does better under Trump than it does under Harris 12 months looking ahead. But all that being said, of course, a lot will depend, of course, on what the economic policy, where the Fed goes as far as this is concerned. The other story as far as this approach to the U.S. elections is concerned has really been this, well, number one is melt up in U.S. yields, which continued overnight to Yvonne's point, right? So I think we were up a further 2-3 basis points on the 10-year yield there. Yeah,
and we talked to a lot of strategists out there that saying maybe, our Treasury is cheap enough now to kind of buy on these dips. And you're starting to see that. Maybe there's a little bit of leg room here to add that duration. But you got to get through the election first before you actually settle on anything. But yeah, the long end, they're saying maybe could be that opportunity.
Yeah, a couple of in fact, for our Bloomberg clients, you can catch, there's a very, very nice summary right now on what the sell side is saying about where you are in yields and what you take advantage of, where you want to be in the curve. As far as the broader index goes for Bloomberg, you look at it on the terminal on your screens right now, it's about a 3.5% drop from the peak, which is almost similar to the repricing we got early at the start of the year when we went from seven rate cuts priced to about 3 we've done some repricing as well on how deep the Fed goes this year, so maybe that might be what's down to this as well. Anyway, let's get into this. Whether it's an equity market story, a bond market story, is it something else?
Yeah, let's bring in Samson, multi-asset portfolio manager at Fidelity International. That movement in yields, I'm just wondering, is it mostly just the fact that we are dealing with the supply concerns out there? Is it the election risk, or do you think it's really been the surprise of the macro data we've gotten out in the U.S. of late?
Yeah, we actually put on pro-dollar trades and preferring bonds outside the U.S. When the macro data started to turn. You had two kind of disappointing employment reports, but since then, in the past month, 6 weeks, you've had really strong retail sales, a rebound in the labor market data that dispelled fears of a recession, and that's just been continuing that momentum. So I think that's what started this move higher in U.S. yields, a fundamental story, and of course is now melting into, how do you position for potentially a change in the political environment, and it's all pushing in that one direction.
Do you look through elections? What I probably hear you saying as well is the U.S. economy will be okay this time next year.
Yeah, if we take a step back, the data in the U.S. has been very strong. So even when there was kind of the Sam rule fears about unemployment picking up, you had, say, the Atlanta Fed's GDP nowcast north of 3%, very strong real GDP growth. And at the same time, because inflation's come down quite significantly, you're going to get at least some degree, probably a meaningful degree of Federal Reserve rate cuts continuing. And that's a pretty bullish backdrop. And so, politics can change things around the margin, it can create uncertainty, but we still anchor on that positive fundamental backdrop.
You said that you're looking at assets outside of treasuries to protect your portfolios. I mean, what is that right hedge right
Sure.
now?
So there's a couple of ways of looking at that. Firstly, government bonds generally are now negatively correlated to equities. For 18 months, 2 years, we didn't have that, and that was a real concern. But now bonds can protect your portfolio again. But we like looking outside U.S. treasuries, whether it's to bonds in New Zealand, whether it's bonds in the UK, places where growth is significantly weaker and there's possibly going to be less supply, in fact, maybe even fiscal tightening, just to get more value and less of an upward drift in yields. So maybe better value while still protecting your portfolio. There are other ways that if you've got more flexible portfolios that you can play this in terms of the protection. We quite like owning, say, decent quality credit where you get a really strong all-in yield and taking some of those coupons and using it to buy kind of upside optionality or downside protection in the options markets where volatility is still pretty cheap.
Right. Just need to be thorough. When you say decent quality credit, is that closer to investment grade, or is it nearer high yield, for example? Like, where do you want to be there?
So one of actually my strongest conviction views right now is there's not much point being in U.S. investment grade credit. And that's because you've got really, really tight spreads and very long spread duration. And to put it simply, that means that a tiny move in spreads, say even 10 basis points, 0.1%, that wipes out your whole year of carry. So we actually prefer being, say in U.S. high yield, double B credit. You can look at things like bank credit, AT1s, things like CLOs that are still pretty decent quality, but are just giving you a higher spread cushion and maybe shorter spread duration. So just, in terms of your risk reward, your Sharpe ratio, that's where we like to be focused.
We tend to talk about, with multi-asset guests, the different narratives that we're seeing across assets right now, where stocks seem to be okay, bond yields are melting up, but that's at odds with the fall in oil prices, but then inflation expectations are also rising as well, and then gold's near records, right? How do you piece all those things together right now? Is it just macro and noise and geopolitics? I mean, how do you separate that? Yeah,
there's a lot to unpick there. Oil in the big picture has been pretty stable for a while, as far as oil markets go, right? Whereas bonds have been more focused on growth and the fiscal issuance picture. And actually, one thing you were referring to just a bit earlier was, earlier this year we had a similar move right at the start of the year where we had almost 7 rate cuts priced in for the Fed, and it all disappeared, which you might think that's going to cause some volatility in assets, and actually equities kept doing fine because the growth picture was still pretty good.
Yeah.
And so how I put it all together is coming back to that big picture. Growth is fine. Policy can ease a bit, maybe not as much as was priced.
Sure.
So we're just looking for assets at the right price point to be slightly overweight risk. And just to make a point on the election, as long as you don't get a recession following a U.S. election, usually you have a really strong few months for equities.
Right.
And given that election, hopefully we'll know the result in a couple of weeks. And we're pretty firmly in the no recession camp now.
Yeah.
We think you need to be looking to be risk on going into the end of the year.
Are we sleeping on inflation becoming a problem again next year? If the economy's okay, if China picks up, for example, if we get magnitudes of, fiscal stimulus in the U.S., that sounds to me like a potential recipe for inflation becoming an issue next year.
When I look at all the inflation data, the underlying core inflation data, surveys, I really like PMI output price components, it looks like we have made a lot of progress towards central banks' 2% targets, but we're certainly not where we were last cycle. We're not persistently below. We're probably persistently we have pressure a little bit above central bank targets. So I don't think you're going to get what we had, say, 2-3 years ago, where there's a huge demand shock, huge positive demand shock, or huge negative supply shock, and inflation is a big concern, but it could be that we just get stuck just that little bit above 2%, and so central banks maybe don't do as much easing as they'd hoped or as was priced. But that's probably a good story. That suggests that demand is still robust.
You've remained neutral when it comes to China. I'm just wondering, has anything changed for you the last 6 weeks or so? Yeah.
Look, there has been a good amount of news flow that suggests that the policymakers in China are willing to be more active in supporting the economy. Now, does that lead to a big growth upswing? I've not seen enough to necessarily believe in that, but it is good to know that, often I like to say, when policymakers start panicking, you can stop panicking because they've got your back. And so that's definitely a positive development. Yeah. Now, say we decide to go into emerging market assets, emerging Asia more aggressively after the U.S. election, I think you want to be taking a basket approach. China definitely would have a place there. You've got the semiconductor names in Korea and Taiwan that continues to do well. All the way over in Latin America, you've got some very, very cheap assets and some solid growth. So I wouldn't want to single out just China, but there could be a strong place for emerging market assets going into next year.
And, that decision doesn't seem to be a function of China. Like, it sounds to me like that isn't a broader EM call. Is it a macro call? Is it a rates falling call and not a China call, for example?
Sure. Usually what you want to see to be moving overweight emerging market assets is you want to be in the middle of the dollar smile, where U.S. growth is neither too strong nor too weak. I think that's roughly where we could end up. Plus, as you say, easing policy globally generally is good for emerging market assets. And so you could definitely paint a picture that that's where we're heading.
Ian, it's great to have you. Ian Samson there, multi-asset portfolio manager at Fidelity International. And still ahead, we're going to have Chinese bonds and the renminbi with BNP Paribas. They have a fair value at 7.7 for the renminbi if the U.S. does apply 60% tariffs on Chinese imports without retaliation. We're going to get Ju Wang's take on all that coming up next. But first, the Biden administration finalizes restrictions on U.S. investments into advanced technology in China. More details coming up, and we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. It is quiet, just given what's in store for us, from a jobs report on Friday to election next week, and the Fed, BOJ as well, all in store for the next 2 weeks or so. Futures, though, slightly to the upside here this morning. This is The China Show.
November 5th, election night is here. Trust Bloomberg for up-to-the-minute results as the races for the White House and Congress are decided, as well as detailed analysis of what it all means for the economy, markets, geopolitics, and more. Tune in at 5 p.m. Eastern for an extended balance of power leading into full team coverage at 7, live from the Battleground States and Harris and Trump HQ. It's election night on Bloomberg. Context changes everything.
Your fix just crossing the Bloomberg here right now, 712.83, pretty much bang in line what analysts were expecting here. But we're still talking about maybe a dollar China at 714. That brings us back to some of the lows that we saw for the renminbi, I think dating back to about 3 months ago, Dave.
Yeah, stay tuned for our coming interview with Ju Wang out of BNP. Joins us in about 13, 14 minutes from now, talking about scenarios here under elections. The reason I say that is this time next week, exchange rates will probably not be at where they are right now, given, of course, this time later next week, roughly speaking. Okay, the agenda today, nothing much going on as far as equity markets go, which is a good thing because I really didn't get good sleep last night. So my mind space is rather limited today, which hopefully these trading ranges will remain quite tight. I actually don't know why I couldn't sleep. Anyway, you have a weekly briefing out of the Hong Kong chief executive, data as far as Macau goes. You have a meeting between the Chinese and Finnish presidents starting today, pun intended there. And, of course, turnover in China was 1.8 trillion day yesterday, so we'll see what happens with that. We'll talk about the EV story in just a moment, of course, but it's also about earnings, too, coming through.
Yeah, so HSBC certainly is the big one. You want to hear a bit more about this whole restructuring efforts from the new CEO and the like. And you got PetroChina, China Merchants Bank, WH Group. So a taste of a little bit of everything now. Bao Steel, so some good things to watch in the next few hours or so. But let's shift to one of our top stories. The Biden administration finalizing curbs on U.S. investment into Chinese chip and AI technology. Let's bring in our tech reporter, Annabelle Drewler. She joined us. So what are the details?
Well, we had an executive order that was signed by President Biden last year. Now there's been sort of a year of consultation, deliberations about how that will be implemented. And what's come out in the last few hours is what's deemed to be the final rule. And so that really spells out the restrictions and also just gives a bit more context as to why this is happening. But there are three sectors that are covered by this. So firstly is chips and microelectronics. The second is quantum technology. And the third is AI. And so what happens next is that U.S. citizens or U.S. people, as the White House says in their statement, are going to be banned from some investments in those industries, or else they're also going to be required to notify the U.S. government of certain transactions involving those industries. So it's sort of an extension because we've seen, of course, a lot of export restrictions put in place, and now we're talking about restrictions on investment on China instead.
And when do the new rules take effect?
They take effect January 2 next year, but we've already had that blueprint being circulated since the midpoint of this year. To give you sort of an example of how it could work in practice, so semiconductors, as I said, is one of the areas that's been highlighted. And so if you're talking about advanced semiconductors, then that would be something that would be banned. A US person couldn't invest in a Chinese company that's producing advanced semiconductors. If you're talking about legacy chips, then it's a bit of a different story. And so a US person might need to notify the US government that it's planning on making this type of investment. The rules around quantum computing as well, they're also spelled out, not just in terms of the computing power that's going to be used to train AI, but it's also about how the technology for AI is going to be applied. And so the real concern here, of course, is that the US doesn't want to see adversaries, and they're specifically singling out China as the country of concern, but they don't want to see China using US technology or US funding to essentially use US technology or develop its technology to then apply against the US instead.
Belle, thank you so much. Annabelle Drewler's there on the latest here as far as that's concerned. Let's pivot now to talk about cars and EVs. So VW is set to close at least 3 factories, eliminate thousands of jobs, and also cut wages as the EU's biggest automaker accelerates its cost-cutting plan. Our transport reporter Danny Lee is here with us on set to talk us through this almost, you hear those 3 major steps. It's almost like we're talking about a crisis here.
Yeah, I think the way in which they're facing up to this challenge of having to cut costs, it's a historic moment, when they're having to cut jobs at home, something they have never done before. The kind of pressure they'll be under not to do so, and this is the culmination of a build-up of all of these challenges over the years, and now what VW is trying to do to save the brand is to cut those costs, yes, but also having to tackle labour up front, and this has gone down really badly, inevitably back home in Germany, and the unions are talking about this as being like this is starvation, a weakening in instalments, and so the kind of the steps here on in to try and slow this down, it seems like inevitable at this point.
And a lot of it has to do with what we've been seeing in China, right? And you're starting to see more. There was a Xinhua report about the central government agencies will increase purchases of these electric car purchases or vehicles. So you're still seeing signs of the government really coming through to step up the development of the industry.
Yeah, I think the benefit is we are heading into this peak season right now of EV purchases in China. Given the tailwind from subsidies to trade in older cars, this is a huge benefit for anyone who has extended range of EV and hybrid models, particularly the Chinese brands, less so for the European legacy players who have been struggling in China. And so this move from the central government agencies, the instruction to boost purchases, will boost fleet purchases and will help. But you can see who the winners might be here, and the ones less so might be the foreign brands.
Yep, and you're seeing those EV stocks react to that news already there. Take a look at NIO. We're up some 10% in the pre-market session in Hong Kong. Our transport reporter Danny Lee joining us here this morning. So EVs are certainly one to watch. In terms of other sectors in particular, we talked about a little bit more of the EV sector. There it is.
Yeah.
Then there is this whole talk about baby stocks. Right? Isn't that one thing that we're watching out for today?
Yeah, I mean, conversations around, how officials want to increase China's soft power, I think, is number one.
Yep.
This big move up in Bitcoin, obviously crypto stocks in focus as well here as well. And, of course, we're in the thick of earnings season, right? So this is more an individual market story. You have bits and pieces of, a property name came out, Shandong Gold came out with a 50% jump in revenue as well. So, yep, we're decently spread across these markets as far as these individual idiosyncratic equity market stories are concerned. That's just me buying 5 seconds more of time. Plenty more ahead. This is Bloomberg. Right, welcome back. So just under 5 minutes away from the opening bell, 0.6% to the upside. It's been an extremely tight and narrow trading range for equity markets in Hong Kong. Yeah, I mean, the downdraft has been multi-week, but the moves haven't been quite substantial week to week. So we're now trading at about 21,000 on the Hang Seng Index, a bit of 0.5% to the upside on A50 futures. Turnover, though, as these trading ranges have remained tight, has actually remained elevated. In fact, I think we had a 1.8 trillion renminbi day yesterday. So things are still very busy underneath the hood here.
I mean, nothing compared to what we saw maybe a few weeks ago, but still, you're seeing a decent amount of activity in terms of turnover. So that still looks pretty good. And seeing a little bit more participation still in this market as well. Of course, as we count down to not just that MPC meeting, I guess that is the next sort of catalyst to watch, at least November. Domestically in China, November 4th to 8th. You're watching the China Show. The Open is next. Welcome back. You're watching the China Show. We're counting down the open of markets in Hong Kong, Shenzhen, and Shanghai. It's pretty slow going when it comes to the rest of the markets. But Hong Kong, and actually you're seeing futures are quite active here this morning. In fact, the Hang Seng is now up about 0.6%. The Nasdaq Golden Dragon had a 4% gain overnight as well. So, it's really kind of a day of swings and gains. And, in this kind of consolidation mode we've seen for the past week or so when it comes to Chinese equities. The dollar is still on the firmer side, though. We're at 7.14 levels for dollar China. We got BNP Paribas coming up to tell us a bit more about what the U.S. election and what this means for dollar China and the path to 7.7. Yeah, the worst case scenario for China bulls, yuan bulls. And yeah, there are several scenarios here, several key questions. We'll get to all the scenarios in just a moment here. So, I mean, it's also a reminder that a week from now is U.S. elections, right? So by this time tomorrow, expect things like your 1 week implied vol and yuan on the Chinese currencies to start picking up. And not just a yuan story, right? That applies to the Japanese currency as well, given how far the yen has also come up. Right. Now, as far as Chinese markets go, as you look at the open here, we're in the thick of earnings season.
And we're also seeing, by the way, and you'll see it in a moment, a lot of big market reaction to some policy pronouncements or media reports around support for certain sectors. The Xinhua reporting some potential purchases of Chinese EVs from central government agencies. That's boosting some equities there. Baby-related stocks on the back of some support around that. Flip the boards, please have a look at Hong Kong and where we are in about 15 minutes from now. We should be getting, if things do proceed on schedule, the Hong Kong Chief Executive, of course, weekly briefing out of John Lee. Right, speaking of EVs and earnings, I think BYD is, I guess, representation of the EV story on your screens right now. 0.3%. I think the one that was really moving in the pre-market was NIO, but we'll show that later. Wuxi Aptech, sales beating estimates there. Shandong Gold has actually moved up quite a lot. I think the company reported a 50% jump in revenue, and Poly Real Estate is the opposite. I think from about 1 billion in sales or revenues, we pulled back a little bit. So close to 200 companies are reporting or have reported so far. We're about 35% through the earnings season. This is a list of some of the companies reporting today. And of course, we're also looking at some of these infant-related shares as officials are pledging support there. And as you can see, there's a boom in baby-related stocks on your screens right now. There we go.
Yeah, so more signs of they're enhancing the housing support and also encouraging those that have big families to buy homes and maybe some more baby subsidies and the like there. So that certainly is lifting some of these baby stocks this morning as well. You take a look at what's been going on with dollar China, right? We talk about how vol has been high. Not just from the yen, but also the renminbi leading up to this election. And now that we're just about less than a week away, you talk about what the scenarios are. BNP has some pretty good ones, right? So fair value for the renminbi could be 7.7 if we in fact see the U.S. applying 60% tariffs and China does not retaliate. What does that happen? You know, what happens after that? Will the central bank step in any way? Let's bring in Ju Wang, head of Greater China FX and Rate Strategy at BNP Paribas here. So tell us a bit more. How do we get to that 7.7 level?
We actually assigned a very simple multilateral exchange rate adjustment model to get this number. So U.S. China now accounts for 14% of U.S. imports. And if we assume that the Trump administration, if they win and they raise the tariffs from current 14% to 60%, that's almost 46% of an increase of average tariff. And that times the 14% of waste that China counts for the U.S.'s total imports. And that applies for a potential starting point of 725, will give us a number of 7.7. But I have to stress, it's a very simple model and can be oversimplified. And the world is much complex than that.
Right. So this is in theory on paper, and in practice in the real world might be slightly different as well. The comparable period was back in Trump 1.0, 2018, 2019. What similarities do you think we have, and what differences do you think we'll get?
I think the similarity is that if there's a tariff, I do believe the Chinese authorities will allow the RMB to adjust to some extent. I mean, this is economic 101. If there's a tariff, the exchange rate has to adjust. No one will go against that principle. But there are two major differences this time. So in exchange rate adjustment model, I mean, there are nominal exchange rate adjustment. There are real exchange rate adjustment. I mean, the model we are using now is nominal exchange rate adjustment model. However, there's a difference this time compared to 2018. The China's nominal exchange rate is almost 15% higher than China's real effective exchange rate since the beginning of 2018. Why is that? Because the rest of the world was running high inflation while China was experiencing a deflation environment for the past 2 to 3 years. Not to mention, China also upgraded its manufacturing sector where the capacity helped by the productivity gains is very competitive right now. So to that extent, some people would argue, why does China need this tick-to-tack nominal exchange rate adjustment towards tariff? Why can't some of the shocks just being absorbed by the fact that the real effective exchange rate is already declining gradually over the past years?
And what sort of counter-cyclical tools do they have, the PBOC, for example, to support the renminbi if we do see these tariffs in place?
I think the fixing, in the end, will do the bulk of the control. I mean, as we saw in 2018, the dollar renminbi fixing did move kind of step by step, and also proportionally towards the market perceived, average tariffs changes. So this time, in that sense, I think will be similar, but there will be a discount. So our view is that even 60% tariffs are applied, the PBOC is most likely to apply some, counter-cyclical measures, including the fixing, and including shadow intervention through the Chinese banks in the FX spot and forward market. There will be some temporary window guidance, against excessive, or cross-border flows, but of course, we do not expect China to bring back capital controls. So in the end, we feel like 750 would be the more acceptable level for the Chinese locals as well as the global stakeholders, especially the emerging market central banks.
If you could talk to us a little bit more about timing, because it's also when they do it and how quickly they allow it to adjust. Do you think we'll start to see the adjustment? Let's say Trump wins. Do you think we'll start to see the adjustment before the implementation of tariffs? Because that risks a currency war before a trade war actually takes place. And what would be considered too big of a move that even exporters are caught off guard?
Yeah. So it's interesting, as you mentioned, the vol has flied for various pairs, especially against the dollar CNH. We're seeing the short-dated vol running at 8%. However, the spot actually moves quite gradual and calm. So essentially, the market is smart enough to think that there could be two steps. And first, when Trump wins, the market will immediately pricing a potential upside in dollar renminbi towards 720, 730. That was the high for this year, and the market will test that level. However, the market is also patiently waiting for the Trump to be in the office and finally announce the tariffs, because they believe that only by that time the China's dollar renminbi fixing will, effectively going higher. And if that moves, the move will be very fast, and that's why the vol is running at a very high level. Right. But the market is really smart to think that PBOC will not preemptively move the dollar renminbi fixing higher before the tariff become official.
And perhaps what's different from 2018 is that we have now policymakers in a coordinated effort to stimulate the economy once again. I mean, do you think the positives of that could actually offset some of the negatives of that tariff risk?
I think 60% tariff for China, 10% for the rest of the world, as Trump is saying during his campaign, is a bit too much. It's a bit too much. We are quite pleased to see that China's domestic policy now has turning more pro-growth. We're waiting for potential announcement out of this November MPC meeting. I mean, we could get some good news on the fiscal side. So that's already start to impact China assets. You can see the China equities already no longer the least performer in the global context. So despite the dollar is trading quite strong, the equity side of sentiment is still relatively, I would say, more optimistic compared to a couple of months ago. So that's very helpful. But I don't think the size of the Chinese stimulus is going to be the bazooka style yet. And that's not going to be completely reverse the global exchange market's trend, especially given this, in case of this very punitive tariff scenario.
One of the scenarios that was talked about and how that maybe shows up in equity markets is an earnings hit for some of these corporates that have exposure to, say, to the U.S. How do you suppose Chinese corporates might react to any tariffs? Do you expect adjustment in pricing? Will there be an impact, for example, or will the PBOC do the heavy lifting to minimize the impact to corporates?
First of all, we think the exchange rate will adjust. Okay. Similar to 2018, 2019, the currency will be the main shock absorber. Secondly, I mean, of course, one more difference we have right now compared to 2018-19 is the corporates are much more experienced of dealing tariffs already. I mean, we heard all the stories of Chinese corporates diversify their capacity, moving some of the capacity into Southeast Asia, Latin America. This will help them to partially absorb the shock from the tariff side. And last but not least, just thinking about the equity market performance, actually, the bulk of the listed company in the Chinese equity markets are domestic demand-driven companies. So in that sense, in the case of Trump tariff scenario, actually the Chinese authority may turn the domestic policy even more supportive just to partially offset the shock from the external side. So in that scenario, actually it may not be a bad news for the domestic stocks. Just look at the experience of 2019, right, when China turned the policy from a tighter regulation, deleveraging in 2018 to slightly more pro-growth. So in the end, the assets performance is the currency trades on the weaker side.
Okay.
But the equities are turned out to be quite okay.
Yeah, and not to mention to your point, right? China is entering a different part in its policy, and of course the Fed, I think, was hiking then, it's cutting now. I want to take this opportunity too to ask you about the yen, if you don't mind, because in one of the last times you were here, we had that massive unwind in the carry. I mean, we're approaching 153, 154 again. Do you think, positioning-wise, we might be sleeping on the risk of a violent unwind in the carry over the next few weeks?
Interestingly, this time I think the market positioning in long dollar is not that heavy.
Okay.
Not yet heavy. I mean, they turned it into long dollar, but the positioning, statistic according to our own model, suggests that they're still relatively light compared to the June, July positioning levels. So in that sense, I think the unwind will be, much more muted if it happens. However, we do acknowledge that if Harris wins, there will be knee-jerk reaction in the FX market. In dollar RMB can go back to 7.10 or even 7-ish level, and dollar yen will also retrace lower for sure.
Okay. You can really talk about anything, Ju. That's amazing how you pulled it out of the hat. Thank you so much for playing ball. Ju Wang, head of Greater China FX and rate strategy at BNP Paribas. Coming up here in shows, President Xi Jinping is urging China to project more soft power as he attempts to challenge the U.S.-led global order. That's up next. This is Bloomberg. It's time for a look at what's trending in China today. At the front page of the People's Daily has President Xi calling on officials to bolster the nation's soft power. Let's bring in our China correspondent, Min Lo, for more on this and take us through the details here of what they're calling for.
Yeah, so President Xi at a study session with a 24-member Politburo had called on officials to bolster China's image overseas, and that includes calling for artistic democracy, supporting these writers, scholars, and artists to create more works, and also calling for innovation when it comes to their online external propaganda. In some ways, this is not new because we know China has had this aim to be a cultural superpower by 2035, but perhaps the task is becoming more urgent given the very hostile external environment we're seeing with the tariffs, the trade barriers, which are coming because of this suspicion towards Chinese intention, right? And that's why China has been doubling down on trying to elevate its status in the world, especially in its appeal to the global south. That's why it held what it called the biggest diplomatic event of this year, the China-Africa Summit. And President Xi himself, who has been traveling very infrequently after the pandemic, he traveled to Russia for the BRICS Summit. And the hope is that this soft power could yield some dividend to perhaps remold the international order to one that is more friendly towards China.
Beyond that, though, we're also hearing some new policy measures to boost people to have babies.
Yes. So the State Council had issued a 13-point plan. They love their multiple-point plans. Yeah. And that includes measures such as expanding fertility services, the medical services, more childcare services, childbearing subsidies, and also encouraging families with multiple children to have homes, encouraging localities that are capable to increase the loan limit to these families. But interestingly, on Chinese social media, the reaction has been quite negative, and I believe that there's probably quite a bit of backlash online because we're seeing hundreds of comments on Chinese social media Weibo, but if you click inside, you can only see like 4 or 5 comments, which suggest that maybe censorship is at work here. But we did see some comments. We could pull out some of those quotes. Some people are saying that 13,000 yuan in subsidy, that's not enough to cover tutorial classes. That's the amount you get for one of the counties in Jiangxi province is offering that amount for families with 2 kids. Others saying give fewer births, you have a happier life. But overall, not very positive comments here. Giving birth to a child would impact your job opportunities, many more factors to weigh in. So perhaps some of those measures may not quite be enough to turn sentiment around.
Yeah. I mean, you'll certainly be less fatigued. But the thing is, housing prices are quite cheap now, right? So the big cost of starting a family is, not a lot of people talk about that, the tax and going forward to multiply.
Education, it's childcare, whether, maternity leave and some of the discrimination some women face at work as well.
Yeah. There's a lot of things. Okay. Min Lin,
you've opened up a lot of doors there. Okay.
Joining us there on some of the measures we've been hearing. All right, we're hearing a little bit more when it comes to Japan now. And, of course, this brutal defeat that the LDP party has had left them scrambling to try to find some sort of coalition, right? So the latest that we've heard so far, and this is Tamaki-san. So he is the head of the Democratic Party for the People in Japan. He's saying they won't join the LPP Komeito ruling coalition. So that maybe puts another, hurdle into this whole equation on what's next for the LDP.
Yeah, not going to happen because he doesn't understand what a partial coalition would actually mean. And I think that's a good reminder that we haven't been in this situation for the better part like 15 years, right? So a lot of these things are taking shape, should be reality. As far as the LDP goes, but of course this is the situation we're in right now. We'll get you an up-to-date. As far as markets go, not much reaction as far as the yen is concerned. A quick glance at my screens. Yep, that seems to be the case as we speak. Plenty more ahead here on The China Show.
Well, GE Aerospace CEO Larry Culp says it would be foolish to bet against Chinese plane maker Comac, as after China's big 3 airlines ordered some 300 jets from the company. Culp also told us exclusively about his outlook for the global aerospace industry.
Given how strong demand is and the progress we and others, our suppliers, our airframer customers are making, we'll continue to drive output. Again, because the demand is so strong, we'll talk about the supply chain, but I don't think this will be a lost decade. I think this will be a very important decade as the industry recovers from the pandemic, modernizes fleets, expands fleets with more fuel-efficient aircraft.
I'd like to touch on China. It has big ambitions, Comac C919. So far, we've seen orders of about 300 coming from the big Chinese carriers. What do you make of that number?
Well, it would suggest that the Chinese carriers like that airplane. We'd like to think one reason they like that airplane is because we have our LEAP 1C engine under wing, sole source in that regard. And I think Comac and the Chinese are quite serious about their intentions with that airplane. And that demand that you just cited really is the beginning of the market acceptance of that aircraft.
Do you think it can be a game changer? Do you think it will reshape the landscape in the aerospace business?
Well, I think that we will see over time how successful Comac and the market acceptance of that airplane is, but it would be very foolish, I think, to bet against Comac and their customers.
What are its biggest challenges?
Well, I think any time that you bring a new aircraft to market in a marketplace as complex as ours, again, as we were talking earlier, there is not only the ramping of the supply chain to produce more of those airplanes every year, but the regional and ultimately the global support network that those airplanes will require. That's a serious undertaking. I think Comac understands that clearly and will do everything they can to master that challenge.
There we go. Larry Culp there speaking with us to Haz, of course, Inside with Haslinda Amin, of course. Catch that interview in full at those times on your screen. So very, very soon, of course. Right, back to markets. To be here now, EVs in focus. So the Xinhua reports talking about how central government agencies will be boosting their purchases. EVs maybe adding a little bit more future revenue to these models right now. Financial models, that is. 10.5% to NIO, Xpeng's better by 4.7%, mirroring a move that we saw certainly overnight in the Golden Dragon Index. We did see a massive, how much was that pop overnight? 4%? Golden Dragon.
4%.
4%, yeah. Apart from this, we talked about some of the infant-related shares also getting a boost out of policy. Bits and pieces around earnings, which I guess we can get to and unpack later on in the show. Broadly speaking, though, it's really been a quiet week so far on price, and I don't want to jinx it, but it's really been all about this approach to U.S. elections too.
I mean, no one's willing to put any risk on the table right now, right? When you have so much uncertainty in the next few days, it's
binary almost.
It is binary. I mean, the U.S. election certainly is binary, but you take a look at that jobs report on Friday. There's also if the Fed just 2 days after this election, right? There's just so much to deal with the next few days or so. So right now, we're pretty much just treading water as we speak. Global macro movers is looking like this here as well. I mean, yes, Treasuries have resumed that sell-off, but it was only just a few basis points to the upside, really. A lot of strategists that we talk to say, is that whole Trump trade really priced in already? It's time to buy, especially the long end here, and add some duration. That's a big question here as well. But you are seeing some of these tech-heavy benchmarks like the TAIEX down now more than 1.5% in Taiwan. You're watching the China Show. Welcome back to the China Show, second hour, and here's a look at the HSI just a half hour into the session. So we're off some of the session highs already, just a half hour into trade, but we're still seeing some upside, about 0.5%. 8 shares are doing a little bit better here, but certainly there's not a whole lot of risk taking here as we count down to many, many big events happening, not just at MPC domestically in China for any signs of fiscal support, but also when it comes to the external picture, right? When you have the Fed, you have this U.S. election all happening next week, Dave.
Yeah, you have the elections, you have the Fed 1 or 2 days after that.
And then you have earnings season.
Then you have earnings season, right? And to start off the week and end the week at 4 to 8 is, to your point, right, the NPC Standing Committee. Sounds like a week we should take off, right? If you wanna...
We should, probably.
I got a shotgun. Me. I'm taking it. I'm taking it off. Would not miss it for the world. Would not miss it for the world. I could catch up on some sleep, though. 0.6% to the upside on the 8 shares index, 0.5% to the upside on the Hang Seng Index. So on price, we've been relatively well behaved. I mean, we've been seeing a downdraft about 3 straight weeks on the Hang Seng Index. Where we have seen activity remain elevated is really onshore in trading activity, right? So $1.8 trillion day yesterday as far as turnover goes, and that remains quite substantial. Talk about chips in a moment. We're going to think of earnings season, so the reason I bring that up is CITIC Securities among the big names reporting this week. It's the busiest earnings week, I believe, on MSCI China for this quarterly reporting season, so keep that in mind. Also, of course, we've been talking about this story, which takes effect on January 2, which is the new curbs around China curbs on semiconductors, 1.9% to the downside on TSMC. Apart from that, I don't know, I'm struggling here. Yvonne, what else are you not seeing?
We've run out of steam already.
Yeah.
But let's go to Mark Cranfield. Maybe he can help us pump our juices a little bit on really what to talk about. Mark Cranfield joins us from our MLive team. Obviously, there's a lot to do with the U.S. election focus. Where in particular are you looking at right now? Because, there's a lot of guests that say, look, it's something that you can kind of trade through, focus on the macro, and just wait for the dust to settle. But what are you focusing on the most now these days?
Yeah, obviously the elections will play a part, but the bigger story really is what the Federal Reserve is going to do. That has a more meaningful traction picture for investors and traders in the months ahead, especially if the messaging that we're getting from the US bond market as yields start to tick up slightly in the market there is that the rate cuts which had been priced into the market are really not going to materialize. The Fed is going to dial back on that. They're even going to threaten and possibly even go ahead with a pause maybe in December or early next year. So this cycle of rate cuts all the way through to the end of next year doesn't look as though it's going to happen now. People are trying to weigh up as to what that means in terms of how low will interest rates go, where is the neutral rate, where is the cutoff going to be. And that's a vastly different picture from one that we had just a few weeks ago, particularly in September when they started their rate cutting. That scenario will continue through the regardless of who wins the elections next week. The Fed will be a very, very big story, and where they're going to take rates to. And of course, neither candidate in the US presidential elections is suggesting that they're going to trim the budget deficit by any meaningful amount. In fact, it's probably going to go the other way. So the rating agencies will also be looking very closely at that, and that will add pressure to the Fed as well, because the sticky inflation that we've been seeing is going to continue, and that could put upward pressure on long-term yields going into next year. So from that point of view, the Fed is a huge story. And of course, in the background, we've got all the things going on in Japan with the election and the Bank of Japan as well.
Yeah, Mark, I was going to ask you about the Fed, but why not talk about dollar yen right now? So our previous guest out of BNP, Ju Wang, talked about how, the positioning around the yen isn't as extreme as it was going into that short squeeze back in early August. Do you subscribe to that view, or is there a short squeeze that's coming before Santa comes around?
The evidence that most people are relying on is the one we get from the CFTC data, and that very clearly shows that positioning is nothing like what it was in July. That was some of the biggest short positioning we've ever seen in the history of dollar yen trading. It's much more modest compared to that. If you look at what's happening in the options market, it suggests that people are beginning to build up dollar yen positions, but again, it's early days. It's not as severe as that, which is a good and a bad thing, because in one way it suggests that if the situation in Japan doesn't clear up quickly, if the Bank of Japan stays quiet, if they stay on hold as they're expected to this week, and they remain relatively dovish, that's all yen negative, and there's plenty of room for traders to build up positions against it. The flip side is if the Bank of Japan surprises, the yen could strengthen very quickly.
Okay, what does it mean for dollar China? I'm just wondering, you're talking about this arbitrage opportunity maybe that we're seeing offshore, onshore. What's it telling you right now?
Well, typically when the onshore yuan is trading much weaker than the offshore trading weaker than the onshore, people would start to fix that spread. They would start to bring it in by buying the yuan in one place and selling in the other. We're not seeing much of that, and that's mostly because of next week's election. Obviously, there's a threat that one way or another, China could end up with more tariffs on their hands. And what we saw last time was that when tariffs were imposed in China, the yuan weakened pretty substantially. So not too many people want to take the big bet that the yuan has priced in all of the bad news. There could well be more to come. And this is where when people become more comfortable that they think the yuan is on a path of starting to make good ground, you would see that spread come in. You may even see the offshore yuan trade stronger than the onshore for a while. There is no evidence of that at the moment, and it suggests that spread is going to stay relatively wide for a while yet, probably until we're clearly through the elections and we get a cleaner picture of what to expect from the United States, and at the same time also what to expect in more stimulus. The MPC meeting from China, of course, is also important in that regard. People might get a long-term picture out of that. So for all of that, there's a bit too much uncertainty for the yuan at the moment.
Mark, thank you so much. As always, Mark Cranfield there out of our MLive team in Singapore for us. So we were talking about the elections there, and certainly also rates uncertainties. Despite those two things, Charles Schwab says it's been noticing a growing global appetite for U.S. investments. Joining us here on set, Lisa Kidd Hunt, Managing Director, Head of International Services at Charles Schwab, to talk us through what she's seeing as far as investment sentiment is concerned in your business. You're in town, of course. I don't know if you could remind us maybe what the footprint is currently of the business, right? And what brings you to town?
Sure. Thank you, David Yvonne. Very good to see you. Thanks for having us here. I'm in town to visit our team. Schwab has a presence in Asia. It's a big market for us, an important market. We have a broker-dealer here in Hong Kong, as well as a broker-dealer in Singapore. And we have a WFOE in mainland China as well.
And are you planning to build out your presence in Asia a little bit, or anything new that you're planning?
Yeah. Well, we continue to grow here in this market. A lot of people don't know that Schwab has been committed to Asia for over 4 decades. Chuck actually established the Hong Kong office here in the early 80s, really before a lot of the big expansion even happened in the U.S. So there was always that vision of the importance of retail investing outside of the United States. As part of our 2025 plan, we will be adding to staff. We have, anywhere between 30 and 40 employees locally here in both Hong Kong and Singapore. And just given the increased interest in U.S. dollar investing and diversifying into the U.S. markets, we continue to see this as being an important place for us to help serve investors.
Yeah. Have you seen those flows pick up?
Yeah, I would say over the last decade or so, since I have been leading this part of our business, we have really seen increased growth in both new accounts as well as assets coming in from Asia. Right. So it's an important growth market for us. You're seeing a rapidly rising middle class, and those consumers are looking more and more to investing as a way to grow their wealth.
How are they looking at this U.S. election right now? I mean, I'm sure you're getting a lot of questions while you're in town about what's the best sort of strategy moving forward.
Well, as we tell all of our clients, timing the market is never a great strategy. And in fact, the U.S., especially the presidential election, typically has very little impact on what happens to the markets. And you're sort of seeing that today. We continue to see a pretty strong momentum in our U.S. markets, even with the incredible uncertainty of the presidential outcome. I think, to use a basketball term, it's basically a jump ball at this point. Maybe we have some indication next week. It'll probably be several weeks before we know the outcome. But presidential candidates promise a lot on the campaign trail. Once they're in office, they've got to rely on Congress, the Senate, the House to really make the rules and the laws. So we tell our clients time in the market is much better than timing the market, and to stay the course based on their financial plans and goals right now.
Yeah, I mean, to your point, right? We've been this U.S. bull market has been really divorced from any whoever was in the White House, right? It's 15 years in the making. And I'm wondering what appetite you're seeing, and we'll talk about the mainland business in a moment, what you're seeing from Chinese investors as it pertains to their appetite for U.S. exposure or non-China exposure at that.
Yeah, I do think that individual investors, retail investors, are really coming into their own. They're taking on a bit more personal responsibility to grow their wealth, and they're looking for ways to do that. So they seek help, they seek guidance, they seek education. And in particular, if they're interested in U.S. markets, we're the place to come to help them navigate that marketplace.
And how would you describe how the level of sophistication has changed?
We've been doing consumer sentiment surveys both in mainland China and here in Hong Kong for a number of years. And we have really seen the confidence level increase, both around investing, but also around sort of goal achievement and wealth creation longer term. I think that the ability to provide more education, more financial literacy help, workshops and other things is really something that Schwab focuses on, both in the U.S. but also here in Asia. And we really try to do it in a very omni-channel way, whether it's in person, whether it's through our multi-language online education capabilities as well. But we really try to make sure our investors are fully educated and understand what they're doing.
Yeah, maybe tell us about some of the research that you've done, particularly amongst the wealthy in China, right? You talk about, we've heard about recent stimulus measures. There's a lot of savings that are being held in these bank accounts now. People are waiting to deploy that. But we still haven't seen that unleashing, right? How much retail investment can be unleashed, do you think?
Well, I do think that what we see in our rising affluent financial well-being index survey, there's a very high level of confidence with investors. At the same time, there is a little bit higher concern now around debt and the amount of debt that they are holding. What's interesting about that, though, it doesn't tie directly in their confidence in their ability to achieve their goals, and doesn't seem to be included as part of their overall financial plan. But I think by and large, they expect things will improve, and they want to be a part of that opportunity.
Yeah, you mentioned before we started, so you're in Hong Kong now, you go to Guangzhou, and then to Shanghai, and then Beijing. You engage with, I would imagine, regulators on a regular basis. Tell us what engagement is like and how your interactions are.
Yeah, so I appreciate you asking that. I think one of the things that we can help or we try to help with at Charles Schwab is really, our 50-plus years of experience around retail investing, what drives consumer confidence, what drives markets, and we really try to work with policymakers, both with our index information. We study thousands of citizens in Tier 1, 2, and 3 cities in China, and really help them with recommendations, if you will, around what we see as opportunities to increase the overall investing that's done on a retail basis. There's still a very high level of cash products, savings, as well as real estate within the portfolios of the mainland Chinese investor. That opportunity to diversify and the understanding around the importance of both geographical diversification but also asset class diversification is still an area that we think there's room to enhance.
And you mentioned about having that wholly owned subsidiary in mainland China. What are the plans in the mainland for you guys? Is there more than just providing research? Are you looking to maybe add services in the country?
We don't know yet.
Okay.
It's a very interesting market to us. It's a very important market. Part of the reason why we've been doing the index study is to really feel like we understand the consumer there. And I think then we will continue to look for ways to potentially add value. It's a big country. It's a very big market. But we want to ensure that we are adding value to the investors in China.
And is the long-term vision to have a broker-dealer in mainland China, or are you happy with the current setup that's via Hong Kong, for example?
Yeah, I think for today, the way we are structured with both a presence here in Hong Kong and Singapore is working very well for us. If an opportunity arises, we always look at opportunities. So I never want to say yes or no to opening a broker-dealer in China, but that's not on the horizon immediately for us.
Okay, Lisa, nice to see you.
Thank you.
Let's do this again next time you're in town. Lisa Kidd-Hunt there, Managing Director and Head of International Services at Schwab. Right, just ahead here on the China Show, HSBC set to deliver earnings in, usually about 2 hours from now. And so we're talking about 3Q earnings. The first report's also under the new leadership. We'll look at what to expect and what sort of guidance also to expect. That's coming up next. This is Bloomberg.
All right, you take a look at how some of these markets are doing, and there's not really a clear story what's going on. I mean, we're just kind of in this consolidation phase here right now. You're going to see some gains day to day, some losses, and HS Tech is up close to 2%. The EV sector certainly is what's driving that, given what we heard from some support measures there from the central government to purchase some of these EV vehicles. So certainly that's one thing we're watching very closely. Let's bring in our Asia Equities Managing Editor, Lanting, too. But in the overall backdrop of all of this, after 6 weeks of crazy volatility, we're talking about how boring these markets are right now, Lanting. It seems like investor confidence is waning now.
Yeah, I think right now, as you just mentioned, consolidation phase, sort of small choppy trading. There are still bulls out there, but plenty of bears as well. And you see that kind of clash between these two groups, right? If you look at the U.S. listed Chinese stocks, the big ETF that tracks the large Chinese stocks already saw the biggest weekly outflow since 2020. And you look at China, I think now people are looking at earnings and looking forward to the MPC meeting, looking forward to the U.S. election. So there is a lot of risks still ahead for investors to digest.
Well, speaking of earnings, how has this reporting season been so far? Any themes, Lanting, that have started to emerge this early on?
Yeah, so far in the snapshot, if you look at MSCI China members, about a third has reported, and they are worse than last quarter, let's put it that way. Negative earnings surprises for those that have reported, we're looking at negative 16% versus about 5% last quarter. But that's all backward looking, right? What we want to focus on is, since the September 24th stimulus blitz, how investors think the earnings will go from here. And from that perspective, we're looking at earnings revisions And we do see a bit of uptick for earnings revisions for the CSI 300 members. We're looking at a 1.5% upward revision from a September low. And so that's positive, but that's still sort of not that much. The overall EPS for the CSI 300 index is at the lowest in about 6 years. And in terms of themes, I think there's still a large number of high-profile Chinese companies that have yet to report. We're talking about tech, right? That, according to our Bloomberg intelligence colleagues, they're still going to lead the EPS growth in Chinese companies, but that seems to be widening out a little bit. So tech leadership is broadening out to the consumer, the traditional banking sectors as well. So that can be taken as positive.
Yeah, and on a positive note, let's leave it there. Lian Ting Tu, our Asia Equities Managing Editor, and just a brief look at earnings coming through today. So you have HSBC among other companies as well. And to Lian Ting's point, it really depends on where you're comparing, the period too, right? So the current set of earnings, EPS, and projections compared to, say, last quarter, the quarter before, things are looking better. You look at revisions from about 6 weeks ago, things are looking better. On an absolute basis compared to 5 years ago, we're effectively at about the same absolute earnings level. Now, we mentioned HSBC set to report earnings 3Q in less than 2 hours from now. It's the new one, of course, under the new leadership for what to expect. Let's bring in Francis Chan, a Bloomberg's intelligence senior analyst, to talk us through what is the view of this set of earnings coming through today.
The investors would definitely focus on any potential cost efforts for HSBC, especially after the announcement of the organizational revamp. And of course, we're not expecting too many details in this quarter's results. Perhaps in February, the full year results, we may have more color. But from the cost front, Bloomberg Intelligence is expecting more than $500 million of savings spreading across 25 and 26. If there will be a full integration between the investment banking and commercial banking units. That's an earlier forecast of ours. And costing is critical because revenue may probably be pretty stagnant amid the Federal Reserve rate cuts. And if HSBC want to maintain this cost efficiency ratio at above 50%, they may need to launch more cost-saving programs.
We talked about last time, too, the separation of certain businesses. Yep. The Asia side is certainly one thing. Can you tell us a bit more about what that impact could look like and what synergies that you see?
Yeah, synergies for the combined units, obviously, like what I said, it could generate some savings. Yeah. And obviously, some overlap, the personnel could be made redundant. But at the same time, about the core competence of HSBC as the world's local bank, global customers ranging from those in the UK to those in Hong Kong, Singapore, they may wonder how the bank may still be able to offer a really seamless global network for their banking needs. And that's one of the concerns. And obviously, some shareholders led by Ping An Insurance would find it really a delight to have this plan. Yeah. There will be easier separation in case of need if HSBC wants to spin off any of the units.
Okay, and hopefully we get more details on this because so far it's been short on the meat as far as how they plan to go about these major changes. Francis, thank you so much. Francis Chan there out of Bloomberg Intelligence.
And of course, you can turn to your Bloomberg for more on this. T-Live Go to get commentary analysis from our expert editors as, of course, those earnings come through here in the next few hours.
Yep, coming up later on the show today, from one David to another, David Solomon joins us now. Exclusive interview with Goldman Sachs Chairman and CEO. He'll be speaking to us live from the Future Investment Initiative in Riyadh. So stay tuned for that interview at those times on your screens. This is Bloomberg. Welcome back. You're watching the China Show. Some top corporate stories we're following right now. Just an update here. So, the Financial Times is reporting that China's Luckin Coffee is planning to enter the U.S. or the U.S. market as early as next year. The report says the company is building out its supply chain and customizing its technology for the market. Now, Luckin is said to be targeting cities with large numbers of Chinese students and tourists, such as places like New York. Luckin Coffee declined to comment on that report. Now, VW plans to close at least 3 factories, slash thousands of jobs, and also cut wages in Germany to turn around its struggling brand. These unprecedented plans, of course, were revealed by the head of VW's Works Council during a rally of some 25,000 workers at the company's headquarters. Now, the company is expected to report declining third-quarter profit and sales midweek. That comes out, of course, on Wednesday.
All right, in terms of movers here, we're watching the likes of Nippon Paint here this morning. So the shares were jumping up the most in 20 years or so for that company after announcing this deal to acquire AOC. This is the U.S.-based chemicals formulators. So the stock is up some 15%, $2.3 billion deal that we're talking about here this morning. And of course, we're still watching some of these media stocks in China with the Chinese president. Given what we've heard from media there, saying that the president is urging the nation to create its cultural soft power and influence globally. So that's why you're seeing some of these media stocks up some 10%. This morning. Plenty more ahead. This is Bloomberg. $11:29 a.m. in Tokyo. Japanese markets are going to that lunch break in just a moment, and we're seeing a little bit of, I guess, a melt up slightly when it comes to equities, but it's not by a whole lot. We're still seeing a bit of a rebound in the yen as well as we continue to digest what happened with this LDP shock. The latest is that DPP party, the one that is actually in terms of more aligned with the LDP, did mention in the last hour or so that they are not interested in joining this coalition with the LDP. So still a lot of questions about what's next for the party and how Ishiba, the prime minister, is going to restore some stability back into the government.
Yeah, what a complication, unexpected complication ahead of the Bank of Japan decision. Broadly speaking, the story is actually quite similar to what we're seeing over in Japan, where you're seeing a little bit of upside on price. Certainly volumes are either flat to slightly lighter or lower, depending on which market you look at. But generally speaking, there's really not a lot of market activity in equity markets today. Most sectors are trading higher. There's some idiosyncratic stories as it pertains to earnings and some sector moves on the back also of, well, separately, some policy tailwinds coming out of China. But apart from that, it's really quiet ahead of, well, this time next week, of course, the big one are the upcoming U.S. elections. And speaking of here, just a week before that democratic exercise, and regardless of really who becomes president, Australia will face a balancing act in maintaining its interests on both the most important strategic ally and, of course, its biggest trading partner, which is China. Paul Allen takes a closer look at this dilemma.
This month, there was bad news for Australian lobsters. They're back on the menu in China after a 4-year trade ban, reviving what had been a $460 million export market. The live lobster ban was the last remaining trade strike China had imposed on Australia after the former Morrison government called for a global investigation into the origins of COVID.
We'll pick up the live lobster from where we left off, but certainly keep our mind on the other markets and particularly the local market. I don't think China will be the same market as what it was when we left off.
It's wise to be cautious. Australia's lobsters and other exports are a potential target should relations sour again, and it's easy to identify potential flashpoints, particularly when Australia's biggest trade partner is a popular punching bag for its biggest ally as the US election campaign draws to a close.
I will make sure that America, not China, wins the competition for the 21st century.
I want to cut taxes on Americans while putting tariffs on China and foreign countries.
While the prospect of a Harris presidency means more predictability around trade, the impact of Trump tariffs could mean upheaval. The good news for Australia is that it runs a trade deficit with the United States, making it an unlikely target. Former Australian ambassador to the US, Joe Hockey, dealt with and golfed with Trump during his administration. He's seen the Trump tariff movie before.
What worked with Trump, as I said, under our trading relationship, you win. you've got a big trade surplus with us. And they throw, oh, but you've got a big trade surplus with China. I go, isn't that great? Someone's getting stuff out of China. We're on your side. And they, oh, okay, yeah, maybe that works. You know, so because it ends up going back to the US because we've got a trade deficit with the US.
In either a Trump or a Harris administration, defence looms as another flashpoint. As a US ally and member of the Quad, Australia's stance in the contested South China Sea is a sore point for China.
Though not directly involved in the South China Sea issue, the United States, Japan, India, and Australia are resorting to microphone diplomacy to criticize and smear China, stirring up troubles and misleading the public.
China is also an opponent of the AUKUS alliance, which would see US nuclear submarine technology transferred to Australia. AUKUS was a Biden project, likely to continue under Harris, and experts see it surviving under Trump as well.
I think Trump will look on AUKUS as a business deal. I think he wants it scrubbed, and he says, oh, this is a really big project. Where's the money going? Where's the contracts going? Where are the jobs going? Does this serve America first? Now, I think he'll come out on the other side as seeing it as an okay agreement.
There is one certainty Australia can rely on after the dust settles on the US election. The diplomatic balancing act will remain as delicate as ever. Paul Allen, Bloomberg, Sydney.
Let's bring in James Laurenceson now, Director of the Australia-China Relations Institute at the University of Technology, Sydney. James, it's great to have you. It's interesting, right? This is coming at a time, this U.S. election, when relations between Canberra and Beijing have stabilized, right? I think they classified it as back on track in some ways. At a time when you have both candidates in the U.S. are still trying to put pressure on China with tariffs and the like, how do you think Australia manages, or at least balances, this sort of delicate act?
Look, I think the Albanese Australian government is frankly doing as best as it possibly could. Obviously, there is a balancing act to pursue here, but in the strategic realm, I think Washington would be quite happy with the Australian government. As your package mentioned, Canberra is very supportive of AUKUS and the Quad and so on. But in the economic realm, it's taking a very different approach to Washington. In fact, I think there's a lot Beijing would like. The Australian government never talks about containing China's economic rise. It's not following the US in putting a tariff on Chinese EVs and banning TikTok. In fact, our trade minister and our prime minister and the opposition leader as well, they all say we want to trade more with China. So you see the balancing act in play, and I think the Albanese government's handling it quite competently.
Yeah, James, David here. In fact, I think if you did a blind test, you wouldn't know that, you'd probably think that Australia is a closer ally to China given the bipartisan support for more economic engagement. I guess the question is, if it is Donald Trump, and it's a big if, of course, how much can he lean into Australia in terms of asking Australia to get on the same side in delivering tariffs and what have you, or has that ship set sail?
Yeah, look, I think you're right to say the anxieties in Australia are greater around a Trump presidency. But frankly, the Biden administration's economic approach towards China has been basically a continuation of the Trump approach. And either way, Canberra is in a very different place to Washington. The US, I think, is, in my view, actually is putting in place policies designed to curtail China's economic rise. But the Australian government firmly rejects that. And it's actually a bipartisan consensus. Australia also benefits from the fact that we're not a leading technology exporter. So I think most of the pressure from the US, from any future US administration, is going to be on countries like Japan, Korea, Taiwan, Germany, which are leading global suppliers of technology, where Australia is mainly in the commodities game. And so I think we're less likely to attract attention. But we could expect some pressure, for example, in technology adjacent sectors like critical minerals. But there, I think the Australian government is going to keep selling all it can to China. I mean, the bottom line is the US is not going to buy our lithium. China is, and so I think we'll be quite determined to keep that trade going.
Yeah, that's an interesting point, right? So you mentioned that you don't see those technological challenges that the US and China have. That's driving this sort of de-risking or decoupling that we're seeing around the world, James. So for Australia's case, then, does it just remain business as usual, that they do, in the end, Australia and China do need each other?
Yeah, they do. And look, as I said before, the bottom line is, I mean, we would love to sell more iron ore, lithium, LNG to countries like the United States. But the fact is they're not buying it. And in fact, the US is actually a competitor to Australia in those industries. I mean, the US talks a lot about friendshoring, for example, but Washington's not content to satisfy future US lithium demand from Australian supply. In fact, it's subsidizing lithium mines and processing facilities in Nevada. So it's trying to build up domestic supply. So there's just that economic reality that I think Canberra is, won't lose sight of, and certainly Australian businesses won't lose sight of that.
James, we're going to leave it there, but thank you so much. James Laurenceson there, director at the Australia-China Relations Institute of the University of Technology, Sydney. A look at some other top global headlines for you this morning. Israel is readying a new laser defense system that can intercept rockets, drones, and mortars. The shield, known as Iron Beam, is expected to be operational next year. The announcement comes as Iran says it will respond to last weekend's Israeli strikes on its missile systems. For security reasons, the Israeli cabinet has moved its regular meeting to an undisclosed location. Israel's parliament, meanwhile, has passed a bill to restrict the main UN organization supporting Palestinians. The bill bans the UN Relief and Works Agency's activities within Israel's territories. While this technically doesn't include Gaza and the West Bank, the agency would be impacted in its daily operations, and the move further threatens the already slow flow of humanitarian aid to Gaza. The Biden administration has finalized restrictions on U.S. investments into advanced technology in China. The rules ban some investments into semiconductors, quantum computing, and AI. The U.S. government must be notified about deals in other industries, and the policy aims to prevent U.S. capital from helping China develop critical technologies that could give Beijing a military edge.
Yeah, well, let's stay on that story, because last week it did emerge that chips tied to or related to TSMC have made their way into Huawei devices, which actually could violate sanctions. Let's bring in Catherine Thorbecke, our Bloomberg opinion columnist, to talk us through this. So, the incident, to your point, Catherine, is a lesson rather than a failure. What do you think then comes of that lesson here?
So I think that there's still a lot of questions about how exactly TSMC chips made their way into Huawei devices, and there's still quite a lot of unknowns. So we'll have to sort of see how this all plays out. TSMC, for its part, has insisted that it's been complying with all regulations and all export rules. But I think, now the big question is how the U.S. government will respond, how the Commerce Department will respond, and if they will sort of inflict penalties on TSMC, whether that's fines or restricting access to U.S. technology. And I sort of argue that at this juncture, both of those moves would probably be unwise. The U.S. really relies on TSMC and is putting a lot of pressure on TSMC for its efforts to onshore semiconductor manufacturing in the U.S. and Arizona. And at the same time, TSMC's biggest customers are Apple and NVIDIA. And so I think, any sort of punishments on TSMC or how they respond here, they should really weigh how that could impact TSMC's ability to, continue mass producing chips for these critical customers.
And it brings a big question of just how effective these U.S. controls are. I mean, how have these export controls aimed at Huawei specifically been playing out?
So I think the Huawei case is especially super interesting because it's been at the center of so many U.S. restrictions for so many years now. And increasingly, there's just a lot of data that shows that, the U.S. efforts to sort of strangle Huawei have really only made it stronger. I mean, part of that is because Beijing has sort of stepped in to, prop up its own domestic tech giant. So part of it is related to those efforts. But I think we'll have to see how it all plays out in the long run. But for now, Huawei's doing really well despite these efforts by the U.S. to really strangle it.
Yeah, to your point, you do understand why some U.S. lawmakers are hence describing this as catastrophic. How does the U.S. learn from this? In other words, how do they tighten the screws even further if, that is, of course, their objective? And, what can they learn from this case here?
So I think one of the lessons here is that these export controls have really proven very porous. I mean, even before the TSMC-Huawei link was sort of exposed, there was a number of reporting that suggested that China was finding very sophisticated ways to get around these export curbs, whether that's loaning chips or sort of hoarding chips before they came out, or even just through a gray market. So I really think the U.S. should sort of use its energy to build up its own domestic tech system and tech ecosystem and sort of channel the energy there rather than just, putting all this effort into trying to hold China back?
Catherine, thank you. Catherine Thorbecke there, our Bloomberg opinion columnist. We got plenty more ahead. This is Bloomberg. All right, we look at a lot of economic indicators on this show. There's an interesting one that's coming up and emerging here. A growing number of money managers are looking at data documenting protests in China as they try to predict what Beijing may do next to boost its economy. Let's get to our Asia government and economy correspondent, Rebecca Chung-Wilkins. She's been investigating and joins us now. So, Rebecca, tell us more about what this story is about.
Well, this has been one of my favorite stories to report because, in a way, it's the story behind the story. For the last couple of years, we've been reporting quite heavily on the different kinds of indicators, the different kind of metrics that we can use to really understand the fallout of the slowdown in the Chinese economy. So everything from, outrageous local government fines, unemployment levels and private data sets for employment, new hiring, as well as direct protests and incidents of dissent in China, particularly around economic issues. And those stories I found have triggered these really interesting conversations with my contacts, with investors, with terminal clients, providing feedback that they too have increasingly been trying to use this data and trying to make sense of this data when it comes to thinking about that social unrest risk. And one thing that I think really underscored, particularly for foreign investors, the importance of this data was what we see behind me. Back in 2022, when China pivoted, President Xi Jinping pivoted on the COVID lockdowns, a really unexpected, abrupt move that took, I think, many foreign investors in particular by surprise and underscored the importance of these social unrest factors when it comes to triggering big 180s in policymakers' approach. So again, the emphasis here is now thinking about how to use this data when it comes to understanding the stimulus that Beijing might be willing to roll out to support the economy and prevent these types of risks.
That's a good point. And might this be, I guess, why we're here right now talking about, 6 weeks from the policy pivot? How is this actionable for investors?
Absolutely. Well, one thing that, one sort of metric or gauge that perhaps is useful for investors, or Morgan Stanley is hoping certainly it's going to be useful for investors, is this social dynamics indicator that they launched just a couple of months ago. Again, underscoring how important this alternative data set is becoming. They look at a whole different range of different metrics, so things like labor incidents as well as employment levels, essentially to create a score. And what they've done is they've run that back in time. And what we see are these two key points, that when we see a drop in the decline in the levels of essentially social satisfaction in China, that they have pivoted, they have created these two big pivots. So back in 2015, when we saw the shantytown renovation stimulus move after weak PPI, and again back in 2022 following those COVID lockdowns. Now, it's not a precise science, so it's not a particularly really clean chart per se, but what is interesting is that you can see this quite clear correlation between these big policy pivots and these stresses that we see in the social dynamic. So just one way that investors are trying to use this. Economists at Morgan Stanley said that this decline that we see right here is partly why we may have seen that bigger than expected, earlier than expected stimulus blitz announced back in November. Robin Singh, Morgan Stanley's China chief economist, saying that we are not yet at that threshold for a big policy pivot, but that we are certainly close.
Yeah, I mentioned that. We're close to the threshold. We're close. He came on a few weeks ago to tell us a bit more about this gauge. So tell us a bit more about what this protest data tells us about overall just discontent in China.
Yeah, so this is China Dissent Monitor data that we see. They have been tracking protest data back from 2022. And we do see this sort of marginal uptick, gradual uptick towards the end. So when we look at it on a quarterly basis, we saw a jump of 18% year over year in the second quarter. We're just waiting for the third quarter data to come in, but we're expecting that to be upwards of 22%. So certainly a rise. The other key element that's interesting is about 3 3/4 of the protests documented in this data set are economic grievances. So these are issues related to unpaid wages for construction workers, issues related to the property sector, homeowners not receiving their property or not receiving property that they think is up to scratch. So certainly we see that, again, that correlation between the economic stresses, the financial stresses that are really weighing on people.
Yep, it's an economy of incentives, isn't it? Or the other way around. Rebecca, thank you so much. Read about that story, of course, for our Bloomberg clients on the terminal, also on the website here. Rebecca Chung-Wilkins, our Asia governments and economy correspondent. Going into this break, we'll talk about the markets next. We're actually up now about 1.1% on MSCI China. We're up 10% as far as volumes go. So there has been, wow, just a recent pickup in prices. We'll try and figure out why. Next, this is Bloomberg.
Well, GE Aerospace CEO Larry Culp says 2026 remains the target date for Boeing to deliver its next flagship aircraft powered by GE engines. He spoke exclusively to Bloomberg's Insight with Haslinda Ahmed.
We'll let Kelly Ortberg and the team at Boeing talk about the schedule for the 777X. I think their last comments talked about an entry into service in 2026. We're thrilled to be the only engine under wing with our new 9X engine. When I talk to customers, they tell me two things. They love that airplane, and they wish they had it yesterday. I think the fact that customers are very keen to see Boeing work through the development and the certification tasks that lie ahead of them is really good news for Boeing. It's good news for us because that's going to be a heck of an airplane once it enters into service.
Airlines like Cathay have expressed a disappointment. I mean, is there a sense, are you confident 2026 is actually viable?
That's the plan that we're working on with Boeing. We know that's the plan that they're working on with every ounce of energy and dedication that they can provide.
You talked about your 9X engine. It's been problematic as well. There are a few challenges there. There have been cracks. Can you talk us through what is happening, what the root cause is, and how are you trying to fix it?
I think you may be referring to a piece of equipment that is attached to the 9X engine, which is a Boeing supplied part, not a GE Aerospace supplied part. So the engine has performed very well over the last several years. It was certified back in 2020. There's plenty of work that we still need to do to be able to ramp side by side with Boeing. But in terms of the core integrity of the engine, we're in very good shape.
So you're saying that it is not on GE to fix a problem, it is on Boeing to fix that problem?
I think the crack that you're referring to is a function of a Boeing supplied component, not a GE engine.
When do you see testing resuming for the 777X? Is there a sense that you're getting in your conversations with Boeing?
That's really for Boeing to speak to publicly in terms of the schedule for that, the resumption of that testing.
Okay, if we've left you wanting more, you can catch the full version of that interview coming up with Insight. Insight, of course, with Haslinda Ahmed. And, of course, join Haslinda for that interview in full at those times, which effectively is about less than 7 minutes from now. Catch that, of course, coming up here after the China show. Before we get to that, though, we'll just take you through a brief look at the Chinese markets and some big movers we're seeing. Before we get to that as well, this reversal we're seeing on the Hang Seng. Oh, do we have that? No? Okay. We'll talk about this first big movers there. Meituan, Wuxi Aptic, which is an earnings story, which we'll get to later on because it's an HSBC story that's an earnings story that's coming through as well in a couple of hours or so. Sunny Optical, one of the big movers to the upside here, 5% move in Sunny Optical here in Hong Kong. Some of these policy tailwinds coming through and showing up in stock prices, EVs and infant-related shares. And we talked about earnings, HSBC, PetroChina, Chalco, and CITIC Securities, bellwethers for their respective industries are all coming out with earnings in a couple of minutes.
Yep, and coming up later on today, we'll have an exclusive interview with Goldman Sachs' chairman and CEO, David Solomon. He'll be speaking to us live from the Future Investment Initiative in Riyadh. That's it for us in the China Show. Insight with Hassan Ahmed is next.